Hey, good evening, everybody. Ken at Tortoise Capital, nightly strategy podcast for Saturday, January 7th, 2023. In Campfire, Charles asked, in the TC 2000, can the 5, 10, 30, and 150-day box be applied to all charts, or do you have to plot each chart individually? So the answer is you can apply it to all of them at once. Yeah, you just check the block when you're adding a box. For example, I'm looking at a 9-day on an ETHE here, which is one of my targets for this week ahead. And so if I wanted to add, say, a 300-day box, I would go. You click the region rather than the box. So if I wanted to add a box here for some reason and have that appear on all my charts, then I would draw it, edit it, apply to all charts. And now if I go to Squarespace, now it's going to appear in all of those. So yeah, that's a very handy device. And then if I remove, if I hit delete, then that'll go ahead and erase from all of them. So go back to ETHE, and then that box is gone from all of them. So yeah, that's your pretty powerful tool. All right, so we'll start with the RL30 slopes, the Z-scores of the sectors. And like we talked about last week, we were coming into the station, and it was going to be very interesting. Were we going to get an up or a down? It feels like everything is starting to cross. Finance is leading the way in green. The S&P and tech are making the turn. Tech is still lagging a little bit, but XLB is doing better. Energy is lagging, although energy turned early enough to help give its little boost already. Like it turned here and helped slow this down. And now finance is leading the way. So as I look at that, the finance is, it fell the least. It started the highest. It fell the least. And that's been the case for a while. So it would not surprise me to see finance leading the way. And in the battle between Goldman Sachs and JP Morgan, it's JP Morgan that's leading the way there. So that's one to, there may be a pair trade or a core and turbo inside that, where you simply are looking at like XLF and then deciding which way you want to go, JP Morgan or Goldman Sachs, for the big banks. In the battle between offense and defense, Staples is still leading the way over discretionary. They're all making the turn, but the easier ones to believe in feel like XLP. Plus, we know that Tesla and Home Depot, who have had a bad quarter, are both the two largest components of XLY, so that's contributing to the underperformance here. But XLP feels good. That also will lead you to DIA, which has more XLP components than growth. So DIA is the strongest U.S. sector right now. When we look at the U.S. sectors, DIA and MDY are better than SPY, which is better than IWM, and Qs are lagging the most. So the good news for the Qs is that if this is going to become a sustained recovery, the tech leaders have a long way to go to regain the leadership role, and at some point they're going to. and so they're more like a value play now than anything, which leads me to look at things like Microsoft and Apple are traditional easy places for fund managers to put a lot of money. But right now, Cisco and IBM are better than Microsoft and Apple. And the whole semiconductor index is beaten down even further, but they even had a nice last couple days. So it could be that the recovery in semis is going to lead to recovery in tech. And then we wouldn't be surprised to see Microsoft and Apple take over. And then in the battle between Microsoft and Apple, until this past week, it was Microsoft. But then they had a horrible earnings report and sold off a lot. And now Apple is slightly in the front, but Microsoft is a longer way to go. And that leads me to Microsoft as an interesting value play on a relative strength basis. All right, let's take a look at, so this is Charles has offered us Merck, and he's using the weekly, daily, and 65-minute frame. Merck has had a consistent relative strength outperformance, which has stood out for weeks and months, and so this little there was no failure in here at all when the rest of the market was working. This thing was going up, stabilizing, and has just started 2 days of next leg up. And so that feels reminiscent of what it did here. And so this is still early days in what could be another nice leg up. So I like this. I like this frame here on the 65 minutes. Wednesday and Thursday had nice moves out of the congestion. Friday it kind of held its own and closed fairly well. So I like the continuation. I'm reluctant to be short the strongest stock in the strongest sector. But if you were going to, I mean, that would be the... I guess what I would say is I would have my stop, I think, not lower than 114. If I was already in this, I think my stop would have to be here because I want to protect against... I want to use 1 unit of risk to protect against 2 units of reward or adverse pain. So that leads me to want to put a stop at about 114, which on the daily chart would be here. like if you've got that gain in hand, you don't want to let it come back into the congestion zone. So I really like that one. There's no resistance overhead. And if there is a general recovery in the markets next week, it's hard to see how people would be buying the broad market but selling the clear leader. So it seems to me that the continuation pattern is a nice one. I mean, you always worry about, am I getting in too late? On this one, I think because the market has been beaten down and it's just starting a 2-day recovery, this one has a good chance to continue if the market continues as well. So I like it. Let's see here. Let's make that a little bigger. Okay. All right, so Dan's given us Alcoa. He also was using the weekly, daily, 65-minute. The weekly has sort of settled into a fence sitter, but with the added advantage of having higher lows, so that weekly trend is certainly up, and there's still room for this to go to 50 before it becomes well overheated, which is still a, from 46 to 50 is still a 10% upside possibility, so that feels good. The strong move on Thursday was offset by selling pressure across all the metals on Friday, but even that has just kind of brought it back into the upper limit of the last trading range. So So now when it's poised at that cusp, it's fair to ask, hey, what's it going to do? Is it going to come up and test this again? And then if it breaks through that, you want to have your second position on. So the upside, is at least 2 to 1. And then the downside is if it fails, you're thinking it could get to 45 pretty easily. So if that's 1 unit of risk, 2 units of reward, and then if this fails, that's where your second position down would be. And then if this fails at 43.50, that's where you want 3 positions short. So this turns out to be postured at a really nice critical state. It's done a nice job on the daily charts of recovering. All right, we're back. All right, so now we're going to look at Microsoft. Appreciate Dan getting this one on there since I've talked it up so much as a value play. Again, so we get the weekly, daily, 65-minute. This kind of 3-day collapse out of this zone here sets up a perfect supported spring crossing, because you can see on the 65 we got a nice turn in the RL10, cross the baby dragon, through the dragon, price is teased the PSAR, so you got a really nice, if this was intraday we'd call it the morning hook, and he's looking for in this frame, the collapsing dragon here with 1 unit of reward and a couple easy units of risk. Realizing, from the daily, if this fails, there's no support over here whatsoever, so a failure there could really fail. And then on the weekly, also you can see that a failure here could take it down to 212 pretty easily. So there's no, it's already past the last weekly support at 222.90, which is here. So that would essentially be being short Microsoft into a free fall into the unknown. And if you were going to be short that would be the place. Now, I would like to see tech and the market both failing at the same time you do that. Then that one could induce some panic in the Microsoft ownership. And the reason being is that all the guys that owned it up here around 300 that endured all of this and then bought it here had a chance to make all their money, and now that's only the really hardcore are holding on to it. But you could imagine how people that were lured into this move could bail right here. Now, they didn't last time it gave that move, and that's the justification, by the way, for the long side trades that are coming out of here, is that you're getting Microsoft at a deep value. Yeah, but that also means that deep value is also setting up this downside trade, which is why we like the compound critical state, because we're going to find out quick, fast, and in a hurry. Here's the little the uncertainty zone right in here. Is it this? Is it going to look more like that? Or does it look like a rebound from oversold conditions, which would take us to here, here, and then across this gap back up to 240. So you got at least 2 clear units of reward on the first leg, and then if it breaks above that, then you feel good about the second leg to the upside. So the value play on this thing is nice. One of the traditional favorite technical patterns is that old cup and handle that looks like this, where you see like Arcata 2. And to me, folks wait to see this recovery, repair all that price, and then see a higher low and starts to take off, because they know that if it breaks above those 2 previous peaks, it's really gone. So they like to wait for this and then and only then get this. But I look at it and say, if I saw such an exaggerated sell-off that was prompted by fear, an emotional response to uncertainty. But then I saw calm hands, steady hands, see that as a buying opportunity. And if I can frame that trade with a small risk, I can look to capture that painful sell-off. Now, going back up, it may not go straight in a rocket ship. This thing might go up the stairs. Like it probably won't be as violent as the sell-off, which is why we like the collapsing dragon, because the pain of selling usually looks like that. But I can tolerate climbing the stairs back to this level. Then if it gets to this level and then there's a pullback and goes, then that's where that cup and handle is completed. But I'd like to take advantage of the bigger move and then take that as a kata 2 or a second position or something like that. So I like seeing half-formed bowls. And you can see that not only on the 65-minute chart, which is this one's starting to turn, 3 big red bars down, and then a green bar that's already started to turn, which is the argument for why it's not irrational to think it can move back. But notice that even on the daily chart, this thing has been a horrible mover, and on a daily chart, it's making the turn. On the weekly, all it's done really is just lose from 260 to 220, a 15% sell-off, and has just started to make the turn. So that's about as low risk an entry on the long side as a value play in Microsoft. You know, you could ask yourself, is Microsoft going to see 300 or 0 first? Which price is Microsoft going to see first, 300 or 0? I don't know. Well, that's if you were risking $225 for the downside. You know, but if I was going to risk $500 on Microsoft and I said, I don't think it's going to 0, that means I could buy 2 shares. Okay. 2 shares and hold 2 shares of Microsoft forever. What would that look like in 40 years? I don't know. But if it's at call it, 220, do I think it's going to 300 first? That's 80. So now the question is, if I want to bet against 40 for 2-1, what's the more like? Is it more likely to see 180 or 300? Now it's a crapshoot, because now if you're betting $40 and you're risking $500, now you're talking about 13 shares versus the 2 shares of no risk. So the position sizing difference is six times by making a $40 bet instead of a $220 bet. But again, on the other side is if I'm betting on this, I'm really only making that's 223 and that's 225. I'm making a $3 bet. That there's a good chance that it could make $6 on the upside without failing $3 on the downside. So if I'm risking $3 and I get $500, now I'm talking 167 shares with a reasonable chance to make $6, which is $1,000 if that pays off for $500 of risk. So that's why we want a 2-1 reasonable reward to risk. And so just on the 65-minute chart, that's reasonable. But now the reason we like the compound critical state is because if that works, it gets above this and starts to go, then a return here for the next $6 is not irrational. So that's almost 4-1. So now you can see that what we've got is a stacked upside trade that begins with a low risk trade. And so if we can take little measured risks all the way up, it wouldn't be irrational to see price get back up to that height and we're just starting it with a small amount, and then each of the risks that we're taking along the way never exceed that first piece. So we're like a mountain climber who's just locking in protection and locking in gains as we go. So that's the argument for the core and turbo, and the finding the Godzillas down here, the compound critical states. So I really like the Microsoft trade specifically because it's Microsoft, but also just for the technical pattern. Because at the same time, the trade that I actually want to be in is this one. And the reason I want to be in that one is because if that fails, it's look out below and fear will continue. So I don't even have to argue about that one. So even though I would prefer to have the short side trade on this one, the fact that it's so obvious and easy means that the upside might not be crazy at all. That there's a lot of reward for a little bit of risk on that side, knowing that if it fails, I'm into the trade I want. So the ideas of compound critical states are really illustrated well here, in that for a small price region of indecision, and it's a coin flip which way it goes, either direction pays off from that little train station. And the fact that it had this much support at that price level suggests that it's not irrational to think that the panic selling that brought it from 245 to 225, a 5% sell-off, that's enough price support action to suggest it's not irrational to think it might be recovering, and that people would be interested in buying Microsoft on a 5% sale. I mean, that's different than if it was some speculative tech company with one product hoping to make a move in the market. I mean, you're talking about Microsoft. So, blue chips on sale at compound critical states in a market that is also doing exactly the same thing, where tech has been beaten down more than anything and showed some signs on Friday of being able to recover. Now you're getting a fractal pattern, not just in time, but now also between target sector and the whole broad market itself. So the market itself is making this turning point at a compound critical state, as is technology, as is Microsoft. So you've got, if it's just the Microsoft buyers, you could see how that could lead you to that quick 2R win. But if technology is going to give a boost, you could see how it could get to the previous support level for another 2R win. And then if the market itself adds strength, you could see how it could then continue on. So you like to stack up those little fractal patterns, not just from time demographics, but also from sector and market. The Walt Disney Company. Now, this is one where Disney has been lagging the rest of the market. It's fallen from, 128 down to 80, which was minus 35%, but has shown some resilience down here. And so this is about 3 or 4 days further along into that recovery pattern than the Microsoft that we just saw. So that's where Microsoft is right now, is that it has just made the turn, but Walt Disney is now 3 days later inside that same pattern, and it cleared the PSAR and is now back into the last consolidated support, and then this is the next target up here around 100 that it wants to get at. Well, when you find them at the turning point on the daily, like Microsoft is, that's where you start seeing things like, that would have been the Kata 2, leg 1 and leg 2. There's actually 2 Kata 2s in this pattern already, Here was the SSC, the first move, and this is why we like the Kata 2, is because you get leg 1, pause, leg 2, and now you might see a leg 3, like it could still get to 100 from 95, but you're really looking at the third leg. Well, and you've already seen 2 legs up, and then the previous thing was big moves down. Now you feel like the early adopters and the second mice, they might be full, and that they might be saying, you know what, I want to protect the money that I made on the way up. So if there's no new wave of third mice coming in to buy this and take it higher, and you see the PSAR break with that small unit of reward, this is just 1/3 of the way back to the last support level. So there's reason to believe that you could see 3 legs on the downside. And even if you just got the first leg to about here, that could pay off. And Disney's been so bad, and that already feels like a comfortable value play. I'm not convinced that you would only set this up in one direction. What's the test on the other side look like? Well, if you said that the price, let's say if I wanted to be short, but that doesn't come to pass, and you put a small box here, and this thing breaks above 95, where's the next place that it stops? Here? That's $3. If you could manage a 50-cent risk, the upside could be there. Now, I think there might be better ones like Microsoft to take advantage of, but I like to see both sides of the trade. Who's on the other side of the trade from me? Who is it that wants to come in and buy this where I really want to be short that? What's their motivation? Well, they're looking to capture a $3 move. And then if it breaks above 100 on the weekly, you can see, oh yeah, they think it's going to 110. So they think it's not only $3, they also think it's another 10 just to get to here. And then the tip of the dragon's at 116, and then 120 for the RL10, and then the all-time, or the previous peak at 128. So there's a value play for Walt Disney. Now, I just think in the face of oncoming recession, well, what's the first part of the family budget to get trimmed? Trips to Disney World? Maybe, I don't know. So I understand the motivation for the short side. That's absolutely sound. But I'm also trying to understand the other side of the trade emotionally and technically so that I don't get locked into a belief that it must do that. I'm now persuaded that if it does fail through here, that's a trade. And I'm also persuaded that some people would see that as a trade. So now I'm disinterested from a directional bias perspective, and then I feel good. All right. United Health has just been getting murdered. And what I want you to notice is the psychology of United Health that was in this little congestion zone here. And then all of a sudden you get one big red. Oh, that's horrible. 2 big reds, 3 big reds. The 4th day down, starting to slow down and find support for a potential turning point. So if we were to think of this in terms of we saw Microsoft, and then we saw that Disney was a little further along, about 3 days further along in that little recovery cycle. Like Microsoft was up in here testing the PSAR to go. And then Disney was already 3 days into that recovery. Now, we look over here at United Health. United Health is just completing the consolidation and establishment of support in a very tight range compression. And then if that were to fail further, there is no way that you would be surprised that there's more selling involved. Because even when you come back over here to the weekly, it's already fallen off the table. And look out below. So you don't have to persuade me that there's more pain and suffering in United Health. So that side of the trade is clearly there, and I would be instantly short on a collapsing dragon. I wouldn't even have to think about it. But that also means that I want to frame this to the upside and say, well, there would be my SSC entry, and for one small unit of risk, I could get recovery to here, recovery to here, recovery to here, and then recovery to here to the far side Z3. So I can make the upside argument for why there's $35 available for about $5 of risk. So that whole thing is a 7-to-1. And that looks like a doji. This is exactly the max pain range compression pattern. And now you can see, the idea of the range max pain range compression in my little background, that you have an amazing shift in psychology when you have this maximum pain downward that terminates in a doji. And so if you can frame that trade either long or short, what you're seeing is the change in psychology from maximum fear to a perfect balance, a tightly compressed balance between buyers and sellers, a measured standoff. The change in psychology from max pain to a doji range compression, that is an enormous shift in psychology. And then you say, well, who's going to win in the tug of war between buyers and sellers? I don't know, but the move is likely to be huge, because if the sellers and the pain comes in, then you're expecting another leg that big. But if it recovers, you're thinking, well, it could be, if that was the maximum sell-off there, maybe I just get a 50% retracement to 510. And if I could get long around 492 to 510, that's $18. Meaning that if I just wanted to frame it as a 2-to-1 risk, I could even risk as much as $9 to still have a 2-to-1. I wouldn't let that thing go from 492 to 483 before I got out. I mean, you'd have a tight stop in there, so you could risk $3 with the hopes of getting 18. Frame that thing in both directions, and then you will see how that allows you to become emotionally disconnected from the trade, so that you can be objectively connected to the trade. That's what you want. Because you want to be able to rehearse the whole trade. All right, next one, mRNA, Moderna. So here's one that, if we looked at that as the trading range on the daily, and then that's the surge to the upside for the optimists, and then they sold it all the way back down. Now notice, when they sold it down, it came and found support at the top of the trading range. So what was once resistance is now support. And then that support held, and it ran 80% of the way back up the stack. Now, the problem there is that it ran out of steam a little bit lower, which means that's your kata 2 to the downside. And then that came down and tested tested support, and it failed to the bottom of the previous trading range, where it held twice, and then actually 3 times if we count that. So you've had one leg up to, that's the size of the move to the upside for the tactical buyers. And then nobody else came in to push it higher than that. And what happened? It sold, and now it's stuck right at the top here. And now for very little risk, you can say the upside trade is there. So if it gets above here, it gets to the PSAR dot, the previous PSAR, and that's the PSAR flip, and it tells you could go higher all the way to 212. So 212 is in target, is in the third leg up, leg 1, leg 2, leg 3. So 212 to the upside, and this captures a reasonable part of that at a minimum risk. But on the other hand, if this fails, you bet I want to be short down, because I think it'll get to 172. And then if 172 cracks, that means all of this stuff is wrong, and now you have this whole leg to capture down to 130. So don't neglect, this is like, a frozen lake that this has been holding all the time. Yeah, but if it thaws and breaks, look out below. So this is quite a long range compression in here, that if it breaks out to the upside, you get a nice move. So nice move available in either direction. I like the trade to the upside. I think I would even be rather than even entering here, I would say if it breaks the Z3, so I want to be in this thing at 182, not 186, because I want that $4, because I'm only going to risk 2. And then if this breaks intraday, I can add a second position here. So I would be willing to, I don't need to, that's an anomaly, those prices. This is the statistical price, and that already broke. So as soon as it breaks above that, I'm ready to go. And I'd put a second position on here and make that, trade that on the 3 or the 10-minute charts in order to capture that extra piece. And then I'd be ready to be short that instantly, because it drops from 180 to 172 right away. That's a no-brainer just to get it here. And then if it breaks below here is where I'd put the second position onto the short side. Okay. So, good frames. Let's see. I'm going to do a quick little speed run here. So I'm going to look at the 9-day frames. And so what I'm going to do, so I'm looking at I'm looking at the 9-day bar, and I'm using the simplified sniper setup, but I've also added in the 90 and the 270. So I'm really getting an RLFF sniper view on a really long-term basis. And what I'm doing is I'm expanding the view of the MACD 4 seasons. I'm using a 1030, but our good friend Trader X likes the 430. So just for purposes of exploring that, I'm going to scale that down to a 430 to get a slightly more granular look. So on the 430, you can see that this move into the winter has had leg 1, 2, and now is getting ready to break into the summer. And what I've done is I've taken our tactical symbol stack and I've sorted it by the weekly spring. All right. So what I want you to notice is that I've got in this view I've got 6 columns for MACD signals. The first 2 are monthly. There's a monthly spring and a monthly summer. So monthly spring and monthly summer means roughly that if I looked at the monthly charts, these things would have gone through a period of winter and then gotten into the spring, and then if it got to the 0 line, crossing it into the summer. So we'd be seeing that kind of a hook. And then we'd say, okay, the fact that it went into the spring and is now into the summer on a monthly basis means there was enough long-term buying pressure that maybe the winter is over. That's so monthly spring and summer. I like catching those 2 turning points. And then I look at this. I use the same frame of reference and look at the weekly spring and weekly summer. Now, what I'm actually doing on this is using the I say weekly, but I'm really using the 9-day. So I should probably change the name of that. So I'm looking at a 9-day chart. So this would really be 9-day spring and summer. I want to go back and look at the go back to my preferred time frame because it's smoother. So what I notice on the MACD, so this is really a MACD sorting scheme. So like I said, the first 2 I'm looking at monthlies, and then I'm looking at 9 days, and then on the dailies I'm looking at 4: daily winter, daily spring, daily summer, daily fall. And then here, this has given me the color codes for which of the daily seasons it's in. And the same thing over here. Everything in my tactical stack that is in a 9-day spring gets a yellow dot in that column. And then when I sort it by that column, I can see all of the symbols that are in that category. So the reason I like weekly spring is, especially in a bear market, the bear market has punished this thing down, and then in the last couple weeks there has been a little bit of recovery. So every symbol in my tactical stack that is following that pattern should be in a 9-day spring as well. If the broad market is doing this, then all of the individual components that are on a spring or a summer should also look like this or better. So I'm going to take, what I'm going to do now is take a look at the weekly springs or the 9-day spring to see which ones are early in their little stack, and then I can drill down to the dailies to see which ones I really like. For instance, I'm going to like XBI already because XBI is on a weekly or 9-day spring and is on a daily summer, as is wheat and precious metals. So if I were to just go, so if I want to combine those time frames into a screen, I can very easily do that. I can just go look at XBI. I'm liking that already. So remember, this is a 9-day, and sorry, I just dropped my pen. One moment. So now when I go to XBI and I'm still on the 9-day, come on. All right, sorry about that, guys. So we go to XBI, still on the 9-day, And it's in the, you would see here's where it went from winter to spring, got through the Red River, and is now testing whether or not it wants to get into summer. So I'd love that. And you can see on the 9-day that it's already establishing kind of a Kata 2, and the PSAR is already flipped, and it's held support here nicely, and the RL10 is already turning. And you have a clear target to the RL90 and the 270, which would be the second leg up. And then if it gets above the 270, you say, well, how far can that go? You say, well, how far did it get below the 270 on the downside? It moved that far. So it could move that far on the way up, which brings it right back to the previous peak. So now, as I look at this with these rising lows in the RL90, I can buy that one with a little risk box. That's a 9-day risk box. And then I have clear targets first to the peak of the RL10 and the 90. And then if that works, the 270 is in target. And if that works, the peak of the Dragon and the RL10 are in target 130. And if that works, the previous peak of the Dragon is in a target about 155, and then the upper limit to here. So I've got a very clear price ladder on the way up for very little risk. And then if that were to break, the PSAR breaks, then my trade is back down into here. So on a simple inspection, so I've got about 60 charts in my boot camp. And so just by looking at the winter, spring, and winter, summer setups, then I can go refine that further on the dailies. And I like the weekly, spring, daily, summer. Daily summer is very strong. So if that's what that looks like on a 9-day, I can drill down to a 3-day and say, yeah, that's failure to fail for sure. Now, the disappointing piece is that it hasn't ever really followed through on any of those breakouts. So it's Fisher cut bait time. It isn't quite a Z3 pinch or super pinch yet, but it's getting there. But could you see that if the market were broadly good, that this would look like a giant Kata 2 on the dailies for this sector? And then if these support levels at 93 break, off it goes. So that's kind of a low risk idea of buying it here with a risk box down here with a reasonable target to the 270, and then if that works, we're free and clear. And on the other hand, if that does fail through the PSAR, I should make that red. If it falls through the PSAR, I can have an idea of being short down to here. So I like that. So that's my idea for XBI. Now if I come down to Boeing, Boeing is also weekly, spring, daily, and this one is one that is further advanced than XBI was, because it is already broken above this. Now I want you to notice how on the Kata 2 it broke through the RL270, and then this move here was strong enough to make the RL270 start sloping up and the 90 to be strong, and the 30 and the 10 are already up and away. But that's what it looks like at the moment of indecision. And when you're down here inside this trade, you're saying, let me play for a return on the first leg up to the previous resistance. Because until proven otherwise, the trading range is from turning point to turning point. But if what was once resistance now becomes support, then you get that kind of a move. And oh, by the way, Boeing has broken out of this little congestion and is going. Boeing is going. Where's it going to go? All the way to here. 238, so there's still some more available. So one of the things you say to yourself is maybe waiting for the daily summer is too long. Maybe what I want is weekly spring and daily spring so that I'm getting it earlier in the move. Oh, well, let's go take a look at lumber here, wood, or Squarespace. That's at the top of the stack. Squarespace is going to look good. I thought it was. Not as, oh, that's sorry, that's on a 3-day. Yeah, on the daily, not as good as I thought. That's right, because I'm looking at daily spring. So it's just monkeying around down in here. That feels like it's dead money. And that's becoming just a compound critical state to break out of. And then if it fails below here, second position. But if it breaks out from here, it's going to get to 90. So I actually don't mind that at all. But that's different than a daily spring. When we looked at XBI, it's already, this is a little bit better. The 270, the 90, and the 30 and the 10 are already pointing up. Boeing, clear example of what a daily summer looks like. Weekly spring, daily summer. So because I like the weekly spring, then if I sort by maybe daily summer, what else do I? Now what I can get is that compound filter and say, give me all the ones that are weekly spring and daily summer. So XBI and BA, and the last one was wheat and precious metals. We'll take a quick look at him. Also in great shape. Now, if you think about weekly spring, daily spring, that looked like when it was back inside that kind of structure and just monkeying around. Daily spring, it hasn't broken out yet. It's not until it becomes summertime here. It went summer, fall, summer. So this is really actually in pretty good shape because it's now clearing that next congestion zone, which is this one. And now the next target is up in here. So my point is, depending on where in the life cycle you want it to be. I mean, what I love is this one, obviously, because if you're a collapsing dragon, you don't even have to think that much. Here's a break of a collapsing dragon. Here's a collapsing dragon break. Here's a collapsing dragon break. Here's one. So that one's actually easier to see. And that was so bad that the 270 rolled all the way down to here. But because of this failure to fail further, it didn't fail. Instead, it did this. That price action was enough to make the RL90 go from down to up. And here's where the RL90 crossed the 270. As an early alert, prepares you to not be surprised if that happens. And then the strength of this move was enough to take the 270 from a downward slope to a sideways slope to just starting to roll up. So that's what a transition state looks like. The RL90 bottoms out, the RL270 bottoms out, meanwhile the 10 and the 30 are cruising. So the whole point of showing you this is that you can actually use this idea of monthly spring and summer, weekly spring and summer, and then the daily winter, spring, summer, fall, as a way to quickly categorize the patterns that you want, and then you get to see where in the life cycle do you want to trade these things. You know, like if I was interested in the short side, well, I would just go right away to daily winters. And these are the one. Now watch how bad these things are. Arc, easy short. Fangs, easy short. Man, that is gonna. If the market fails, these are the large cap techs. This is where all that weakness in tech was coming. That's the losses in Alphabet and Meta and Microsoft and Apple, all those guys. So if this were to fail, and if this were to fail, look out below, fellas. Bitcoin, same pattern. Nvidia, I like this one. Nvidia has already put in the first little cotta too, but it's still so bad. This move down was so bad that it is still, that this move here was enough to take it from summer, fall, winter, and it just based right here, and I look at that as the whole semi-index. So if this were to get some strength up into here, that would be enough to take it from winter to spring, and then if it breaks above here, you would see the MACD break into the summer. So if you love that part of the curve like I do, you love the daily winter, and then if you combine weekly spring with daily winter, what you're getting is something that was horrible, then had a slight turn, and it has a pullback, and is making a cotta 2. That's what spring on the weekly or the 9-day, right? The 9 and the daily winter looks like. Whereas if I go look at these that are in the daily summer, and Boeing is the best example, that isn't failing. That's already running. That's the difference between daily summer and daily winter. They both featured that 9-day spring, but that's the difference in the daily pattern. So this little sorting mechanism over here is really a nice way to quickly filter the 60 symbols that I have in my tactical stack, and I'm always ready to trade any of those. If I just wanted to quickly, oops, what did I just do there? Sorry. That's what I want to see. Yeah, if I just wanted to look at the ones that were in, I guess daily summer. There we go. I'd be looking at let's see, uranium. I really like Boeing as a continuation. The Aussie dollar just getting ready to go. Cliff Natural Resources, love it. Wheat and precious metals, and then biotech hasn't made its move yet, but I might just bracket that one and be ready to run with it. So that's just a quick look at how, with TC2000 in the bundle, you can you can use the MACD Four Seasons to really help you manage all of the symbols in your herd. And by the way, you're not limited just to that. I can change up the instead of my boot camp or tactical set. Hey, maybe I just want to look at the S&P 500. And now, if I sort it by daily, now you can obviously see that you get. If you love weekly spring and daily summer, there's 50 symbols in the S&P 500 that fit that category. Notice how they all share that same basic frame of rep. That one looks like Colgate. And for me, the summer, that daily summer, I don't like to start looking at them at that one. I like to catch them down in here. So I wanted things to have come to the winter and just become spring. So I like daily spring. So maybe what I want is a weekly spring and a daily spring. So how about that? PayPal. Now it's a little earlier. It doesn't feel as easy. Yeah, it shouldn't feel easy because that's why it's a trade. Because you're getting in earlier. Now, notice the next two. Texas Instruments. Intel. Now, I like Intel. Lack of volatility. This has been so bad for so long. Here was the first little rebound, which took it all the way up to 31. The sell-off in 3 legs made a higher low. Caught a 2. Daily spring. Had a really strong move, and now the continuation pattern, and then second position here, which will take it to 36. Intel. Okay, so without droning on further, that's an idea about how you figure out where the fish are biting. But I want to go back and just remind you, it started with a 9-day. Now look at Intel on the 9. Now I was really attracted to that on the daily chart. And you can see from the 9-day, this is where it used to be. That long collapsing dragon. But that has turned. There's your P1. It's tested once into the dragon, failed. Now getting ready to come out of the dragon, PSAR flipping, target, target, target. This thing's ready to break. Now, is that going to be a rocket sled? Is it going to just be the inverse? No. It's likely to fall out the window and then climb up the steps in measured moves. It typically takes 3 to 5 times longer to make that move than it did to make that move. Which is why you like the collapsing dragon when it occurs, because you get all of it at once, like this one here. You get all of it right away and done. So that's the demonstration of TC2000 and the Four Seasons. So that's everything I got for you today. We'll get this published and posted, and we'll be ready for the creativity guys tomorrow morning. And see you then.